Welcome back to all our listeners. This is another episode for Gold for a New Generation. Steve, how you doing?
Doing great.
Great.
Great to see you so soon after our last podcast.
Exactly. This is a double header episode. Today is March 19th, 2021. We did record our ninth episode just yesterday. Today's topic is a little bit is pretty interesting and a little bit more complex. It has to do with topics that aren't exactly about gold, but they're topics that aren't really spoken on your general news show, and we thought that they are interesting. They're a little more inherent within the capital markets, and we do want to talk about them. And we do want to tie it up to gold a little bit at the end. It is our favorite subject after all. Today's topics are going to cover things like interest rates and quarterly rebalances, um, narrative bias, how insurance and liability management, and connect all of that to how higher interest rates could affect the prices of gold mining stocks. So, Steve, want to start us off with narrative biases?
Yeah, definitely. Yeah, no, that's a good setup, Raphael. We're going to look at a lot of dominoes today, and so this is definitely something different from what we normally get into. But I think it's unique right now, and it helps. It helps people understand that there's a lot of forces at play in markets that they may not see, but that have a lot of impact. And so I want to start with a broader subject, which is narrative bias. And I love this topic. I'm really fascinated with narrative bias, which is narrative bias is we as humans we have this very strong bias to um, simple cause and effect stories. This some X happens and that makes Y happen. That's our brains are designed to kind of make those kinds of simple cause and effect connections. Now, I want to go through a really powerful example of narrative bias, unrelated to markets, but I'm hoping a lot of people can relate to this and see, how narrative bias plays a role, and then we're going to tie it into markets. So, narrative bias example, the U.S. presidential debates back in 2016, when Donald Trump, and this is before the Republicans had chosen Donald Trump, and there was Donald Trump, and there was a bunch of other candidates trying to be the Republican nominee. And one of the questions in one of these debates was, do you believe that vaccines cause autism? And there was another candidate named Ben Carson, who was a top doctor, considered quite a top doctor in his field. And he said, well, I mean, you look at the data, it's pretty clear there's no, connection or no significant connection between vaccines and autism. And then Donald Trump jumps in. He says, well, wait, hold on. I had an employee that had a beautiful young child and got vaccinated, and then a month later was diagnosed with autism. And so it looks to me like vaccines could cause autism. That's definitely possible, right? And that's an example of simple cause and effect narrative bias. Uh, Someone is diagnosed with autism a month or 2 or 3 months ago. They had vaccines. That must have caused the autism, right? And also we tend to look for external causes, right? That it was something external. I brought my child to the doctor and they got vaccinated and then they got autism, right? That external effect caused the autism. When likely, and I'm no doctor, that's for sure, but it's likely autism, is more of an internal development that we're all born with certain DNA and so forth, and then over time our bodies and our minds and our brains develop, and there's probably something there that autism develops, early on. I'm not sure what age, but let's say it develops typically between ages, 4 and 6 or something like that, where it's noticed. And it's just an internal development aspect, it is, and the fact that most kids get vaccines when they're 4 or 5 or 6 years old, it's easy to try and create this cause and effect link or narrative that really isn't there. But it's really powerful. And a lot of people can look at that and say, okay, yeah, we can see that, we can look at the data, we're able to analyze it and see that there really isn't, certainly no strong connection and likely no connection between vaccines and autism. But now when it comes to financial markets, right, people really, really want that external cause and effect story. We really have this powerful narrative bias. So when markets are up or markets are down, what caused it? And I can see, when I talk to some of our listeners, it's like, well, what is the vaccine going to do to gold? What is the stimulus going to do? What is the tax policy? These are all external effects, and for sure they can have an impact. But what people miss is a lot of the internal market dynamics that are really can, not always, but can be really powerful and can drive markets, certainly in the short term and even in the long term, it can drive them quite a bit. And, this is where we want to get into some other forces out there that I think are really interesting that could have a lot of impact on markets, and they could impact gold and gold mining stocks and how we can connect them all. So these are more advanced topics, as you kind of highlighted at the start. This is more complex, but I'm going to touch on two things, both related to bonds, but this idea of how people rebalance between stocks and bonds, and then what is a big demand driver of bonds and how that some interesting forces at play there. But maybe just before I do that, any questions, Raphael, on narrative bias or anything that you want to highlight before I jump into those next topics?
Well, no questions, but I personally think that, we like narrative biases because they're comfortable, because it'd be really nice to know that X happened because Y happened. And in fact, over our podcasts, I kind of mentioned, like things that are external effects that I mention them as I talk about the price of gold, assuming that they will affect the price of gold. Like, for example, stimulus checks, right? A lot of money created could cause the depreciation of the value of regular cash, which could appreciate the price of gold, or high interest rates, which could affect, X, Y, Z, and come back down to gold. But yeah, I'm really looking forward to talking a little bit more about the internal factors, because adding that to your overall analysis of something, could enhance your analysis overall. And yeah, knowing cycles that I think we're going to talk about are a pro for sure. So yeah, go ahead. You wanted to talk
Yeah.
about
Okay.
more like the bonds and interest rate. I wanted to kind of start, you know, talking a little bit of an external factor, which is interest rates have been going up. Interest rates have gone up
Yes.
about 1.5% over since the beginning of January 2021. And I feel like that is a big factor that would influence a lot of the internal factors that we're going to touch on today.
Yeah. So interest rates. So this is, like, to me, interest rates is like such an important fundamental aspect of financial markets, and we want this. What is externally driving interest rates? And there's kind of this view that well, the market is anticipating more inflation, and that's possible for sure. But I think there's other factors going on. And one thing that's important for our listeners to understand, I think some of them will understand this, some not, but as interest rates go up, bond prices go down, right? So that you're discounting your cash flows at a higher interest rate, and that's making a smaller present value. So interest rates go up, bond prices go down. So I'm going to share, for those watching the video, You'll be able to see this. For those on the podcast, just use your imagination. But I'm going to show a graph of the largest bond ETF in the world. The ticker is TLT, and it's an ETF that holds an exchange-traded fund that holds long-term U.S. government bonds, 20 years and greater in term. So, they might have a bond maturing in, 2050, something like that in this ETF. And, we even talked, if you recall back in early January, we talked about interest rates. And I said, wow, interest rates are starting to creep up here. It's going to be fascinating if they really start to take off. And so this is the bond ETF. So we can see as interest rates go up, prices are going down. But I'm just going to go to the US 30-year interest rate just to look at briefly. And, back in January, when we were talking about, hey, interest rates are starting to creep up, long-term interest rates in the US, they were at about 1.6, 1.7%. Now they've jumped up to 2.4%. And if we look over time, we can see interest rates have actually been declining, and they hit a low point last year, and then they've been starting to go up. So, this idea of interest rates going up causes bond prices to go down.
Yeah, just highlighting the inverse effect, right? We just saw that interest rates went up, and that caused the graph that we're looking at right now, bond prices going down.
Exactly. Yeah. And so there's a couple things that I want to get into in bond prices. The first thing I'm going to get into is, what does this mean for equities? Is there any connection with equities? And this is an internal market dynamic that you really don't hear discussed very much, but here it is. So a lot of retirement money, particularly in the US, but around the world, people's retirement savings are managed on a basis of a certain percentage in bonds and a certain percentage in stocks. So, the classic ratio is 40% bonds, 60% stocks. Now, the idea is, markets bounce around, and it kind of reduces the volatility of your portfolio, and that's how you want to manage it. But the one thing that also happens is, as bond prices and stock prices move around, there's typically, not always, but typically every 3 months or so, a rebalancing takes place. So if bond prices have gone down and stocks have gone up, well, you have to sell some stocks and buy some more bonds. Okay. Now, one thing that's happened, in the last 3 months, specifically all within this quarter, if you look at long-term bond prices, they've gone down, in the range of 15%. Right? So bond prices have gone down, stocks have gone up, maybe 5%, let's say on average, depending on what market you're in. So to rebalance, you have to sell a certain amount of stocks, buy a certain amount of bonds. Okay. If you look at the US, there's in the range of retirement money of, say, 5 to 10 trillion or more that's managed with this kind of rebalancing methodology. If you've, some of our American listeners would definitely heard of target date funds, which are, you've targeted a certain retirement date, and they over time shift your allocation, but they also rebalance. And so what we're going to see with this huge drop in bonds is there needs to be a lot of sales in stocks to buy bonds to get those back in your appropriate ratio. And, we're maybe talking, 300 billion, 400 billion, something like that, kind of that order of magnitude of stocks that need to get sold and bonds that need to get bought. Okay, which this is, nothing to do for the most part with external forces on markets. This is just within markets. Well, something, there's been some causes with respect to interest rates, which we'll get into, but hey, interest rates have gone up, bond prices have gone down. In the second quarter of this year, there's going to be this rebalancing effort to sell stocks and buy bonds. So And one thing we're going to find out is when, 200, 300, 400 billion of stocks are sold to buy bonds, can the stock market, the US stock market, absorb that? Maybe it can, maybe it can't. If it can't, and we see stocks drop 10%, 15%, 20%, whatever, just because of this selling pressure just from rebalancing, that certainly could impact all equities, including all stocks, including gold mining stocks. And maybe that's the push, that final push, just to clear out all the leverage that really accumulated back last summer in gold and gold mining stocks. So we're starting to draw these connections between interest rates going up, bond prices going down, rebalancing, forcing equity stock sales to buy bonds, and that affects gold mining stocks, right? None of these things are really those things that you'll see on the news, right? You never turn on CNBC or BNN or whatever it might be, and you hear someone going, and today the rebalancing starts, and it's what's going to happen to the rebalancing, right? Like it's they're not looking at these internal market dynamics and what they can cause. So that's something to keep in mind. I mean, there's lots of forces at play, and there still is important external market dynamics. There's huge amounts of stimulus. There's also tax policy being discussed, and should they raise capital gains taxes and things like that in the U.S. So there's a lot of those forces still can be important, but just so you know, there's a lot of internal forces, and our brains aren't so queued up for that. They want those external cause and effect stories to satisfy our brains. As you said, there's some comfort in that, but just making people there's aware of these dynamics. And we've talked about in gold and leverage and how that can affect things in the short term. But it is to me, it's pretty fascinating how this rebalancing effect is going to turn out. I don't think we can make any guarantees as to what this is going to do, but it is something to keep in mind here for the second quarter and how it might leak into other investments.
So the aggregate of all the pension fund portfolios within a certain region of the world, let's say North America, as you said, is about $5 to $10 trillion, maybe more if I include Canada in that calculation, right? Then the percent of rebalancing would be around, let's say, $500 billion worth of rebalancing, pulling that out of the stock market, out of equities, making that drop, putting that back into the bond market. I'm assuming that's a lot of demand for bonds, causing the bond prices to go up, causing interest rates to perhaps come back down a little bit, not pinpointing a reason of certain reactions, but just saying that's a possibility. And that's another interesting thing to look at. Go ahead.
Yeah. So, I mean, that's a really important point. So it's, it could drive stock prices down and increase bond prices. But now there's other dynamics in the bond market that are also internal market dynamics. And this is something that almost no one is talking about. So this is something that I'm really want to get into here is what, if we kind of stand back and go, okay, wait a sec, we have seen bond prices ratcheting up, over the last, 30, 40 years, which means interest rates have been declining. Probably everyone on this podcast is aware that interest rates have declined quite a bit in the last, number of years. And you've probably heard of negative interest rates in Europe and Japan and near zero interest rates. And if we look, go back to our U.S. interest rates here, we can see that the 30-year long-term interest rates fell under 1% last March, and they've been hovering about 1%, but they've jumped up to about 2.5%. So here's here's some dynamics that, again, people aren't aware of that I believe have been driving um, interest rates even lower, and then are now perhaps in reverse driving interest rates higher. And I used to work for a large insurance company, and insurance companies and pension plans to some extent are enormous drivers of demand for bonds. Enormous trillions of dollars of bonds are owned and bought over time by insurance companies and pension plans. And the reason they're doing that is they're trying to what's called matching. They're trying to match. They've got all these long-term obligations. You retire at 55, and you're going to receive a payment until you're 100 or whatever. 45 years of payments. Or an insurance company, you're 30 years old and you buy a life insurance policy, and you're likely not going to die at age 30. You're likely going to continue paying premiums, and those claims are going to be out 30, 40, 50 years from now. So they have these really long-term obligations, and they do this matching. They say, okay, I know roughly I'm going to have to make these kinds of payments 20 years from now, 30 years from now, 40 years from now. So what am I going to do? I'm going to buy some long-term bonds to match that. So, hey, I've got a bond. It's going to mature in 30 years, just when I need the cash to pay my pensioners or pay my life insurance claims. So generally, life insurance companies and pension plans are one of the biggest, if not the biggest, driver of demand for long-term bonds. Now, one funny thing happens as interest rates decline. As interest rates decline, it makes those really long-term liabilities and obligations and cash flows out there, pension cash flows, life insurance cash flows, become much more important. Why is that? Because, think about if you got an interest rate, say at 10%, and you're discounting something that's out 40 years from now. Well, discounting something for 40 years at 10%, it could be $1 billion cash flow, but you get back to now and you discount it and it's worth, very little. Okay. But if interest rates are at 0%, that $1 billion cash flow 40 years from now is worth $40 billion or $1 billion today, right? So what happened with as interest rates declined was there was more and more demand for these long-term bonds. It was like, wow, and they have various regulations and risk management tools and so forth. And as interest rates are declining, hey, these long-term obligations, we need to make sure we're better hedged and better matched. So we need to buy even more long-term bonds. And generally, bonds, the longest you can buy are maybe 30 years, even though you've got insurance and pension cash flows out 50, 60 years. So you just, okay, well, we got to buy more and more 30-year bonds. It's how this kind of runs its course. And when I worked for an insurance company, I saw it all the time. It was like, oh, interest rates are down. Well, we need to buy more long-term bonds. And, it would be, oh, well, all the insurance companies, all the pension plans are trying to buy more long-term bonds. This creates more demand for long-term bonds. Well, what does that do? As more people buy long-term bonds, it forces bond prices up and interest rates even lower. And so you get in this funny circular loop where as interest rates are going down, there's more demand for long-term bonds, which forces interest rates down even more, which creates more demand for long-term bonds. And you get this feedback loop, whether you want to call it a vicious cycle or a virtuous cycle, that's driving interest rates down. So this is interest rates, they just ratcheting down for many years. And the inverse of that, if we go back to the ETF, the bond ETF, is they keep going up. Bond prices keep going up. And again, I could see this dynamic play out. And so, there was always this debate. Why are interest rates going down? There's lots of forces and people want that external driver, that simple cause and effect story from external drivers. And it's like, well, part of it, some part of it, maybe a lot of it, is simply a feedback loop that just keeps going and cycling that way. And eventually, any feedback loop eventually dies out. It can never go forever. And yeah, that could have been this blow off top in bond prices last year or the last couple of years. And now, as interest rates start to creep up, this dynamic starts to operate in reverse, right? Whereas interest rates go up and now bond prices start to go down, like this ETF, that forces insurance companies and pension plans to start selling these long-term bonds. So you have this powerful force that's at play that potentially could feed on itself and force bond prices even lower and interest rates even higher. Okay, so there's you can hopefully our listeners can see these all these powerful internal forces and dynamics at play where, hey, interest rates were going one way, and as interest rates were going down and people are buying, or pension plans, insurance companies are buying more stocks or buying more long-term bonds. But then as this starts to unwind, now bond prices are going down and people now have to rebalance the other way and start selling stocks and buying bonds, pension plans and retirement funds. You're getting all these forces at play that little bit hard, maybe very hard to predict how it's all going to unfold. But make a very long story short, there's these very important and powerful, extremely powerful internal market forces that you don't hear in the news. You don't think are necessarily affecting markets so much, but they have a very powerful impact. And this is something, these are forces that could certainly impact financial markets significantly in the coming years. And this is also kind of why we've tried to highlight to people thinking about diversifying, thinking about not just stocks and bonds, but thinking about other asset classes as well. This all of this does tie together, but the main thing is understanding that there are these market forces that can drive markets, not due to external dynamics or external forces, but simply within the markets themselves and how they evolve over time.
Awesome. If you don't mind, do you think we can dig in just a little bit about the reversal effect of the feedback loop, right? So
Yes.
I could see how, parties would be interested in selling the bonds because the bonds are becoming cheaper, perhaps, than what they bought it for, and it's becoming non-profitable. But they still need to match certain bond cash flows to certain liabilities. So there still has to be demand for bonds. I'm assuming the original feedback loop where prices of bonds went up when interest rates went down was supported by the fact that we still need to match liabilities with cash flows. But
Right.
I guess what I'm asking is, and I know like insurance companies aren't the only force at play that affect the bond prices and the interest rates for those prices, but nevertheless, there's still going to be a lot of demand from them to match bond bond cash flows to their liabilities. So how would that reverse feedback loop where bonds are constantly becoming cheaper going to play out for them?
Yeah, so there's a little more detail that I kind of skipped over there, and it gets a little more advanced for our audience, but I'll jump into it. And certainly, yeah, it's not like this eliminates demand for long-term bonds, but it can dramatically suppress that demand. And the reason for that, I hinted a little bit when I was going through, but there's this fundamental issue that insurance companies and pension plans have dealt with. And I saw it when I worked for an insurance company is you've got, um, generally, if you're trying to buy bonds, the longest term you can buy is maybe 30 years. Today, we're 2021, the government of Canada or government of US issues a 30-year bond and matures in 2051. And you can go a little bit beyond that, for sure. But generally, you can buy bonds, say up to 30 years, keep it simple. But insurance company and pension plan obligations go out 50 or 60 or 70 years. So it's what insurance companies and pension plans do is, yeah, they try and match their cash flows, their bond, bond maturities and so forth with their obligations to pensioners and so forth. But on that, once they get to a certain point, all they can do is they can't really cash flow match. What they do is duration match. So they say, what's the duration of my obligations? What is the duration of my assets? And, the idea there for those that aren't familiar with duration is it's a measure of sensitivity, and it's just a way of kind of on average keeping things in sync. So, hey, yeah, I've got a bunch of obligations out 40, 50, 60 years, but what I'll do is I'll just hold a whole bunch of 30-year bonds to match that. Okay, so on average, yeah, it's kind of right. We don't have to worry about it too much. But the idea is as interest rates go down, that becomes more and more of a problem because all of a sudden those 60 and 70-year obligations become more and more important. So that it's that duration matching that really drives this insatiable demand for 30-year bonds. And you still need some out there to the matching, but as interest rates start going up, it's, hey, this duration matching is such that I don't really need as much 30-year bonds to hedge those really long-term obligations. Now, it is definitely the right way to do this would bring up a spreadsheet and show you all the math and show you how it works. But that's the issue is this duration matching of insurance company and pension plan assets to their obligations that, as interest rates were declining, forced them more and more long-term bonds, and as that interest rates go up, it forces them to sell them. And you kind of think that there's still typical demand for 30-year bonds, but instead of it, let's say being, I'm going to just throw out some numbers, instead of it being $1 trillion a year, it's only $200 billion a year now, under rising interest rate kind of environment. So yeah, so there is some more detail there that we're kind of glossing over a little bit. But that's the dynamic. And it's a powerful dynamic. I've seen it. And I'm thinking it's happening now in reverse.
Okay, that makes it a lot more clear. Thank you for that. So overall, the idea of the podcast was to kind of connect these dynamics to kind of connect it to gold after all, because it is our favorite subject. So the idea is, interest rates have gone up. It caused the bond prices to go down. And there's going to be some rebalancing at the end of this quarter, where we're going to have to see, portfolios sell perhaps a portion of their stock portfolio and buy a lot of the bond portfolio, which could cause, the stock portfolios or the stock indices to go down a little bit. And in those indices, in general, in the capital markets, there are gold mining stocks. And so when the indices start going down, that could cause the gold mining companies to start going down. And that could cause a bit of the leverage that's left over since the summer to clear up for sell, which could potentially cause the bigger dip that we've spoken about a couple of times in our podcast so far. So yeah, it'd be interesting to see what happens over the next couple of weeks. In addition to that, it was super cool to see some of your insight from your experience in an insurance company. in regards to interest rates and fixed income. So thank you for that as well.
And just one thing, just to clarify. So that was a really, really good summary of all
Yeah.
that we talked. I mean, I talked for quite a bit, and you really nicely put it together there. The one thing I would just highlight is you said over the next 2 weeks.
Couple of
Um,
weeks.
uh,
Yeah, but yeah.
the rebalancing that I mentioned is probably something that's going to happen more in the second quarter. Now there could be an anticipation of that, but um, it's something that's maybe going to stretch out over a few months or a couple months. Um, that and again, it's hard to know exactly the impact and what other forces are out there. How much money is out there just waiting for a stock market decline to jump in. Um,
And that
but
was
yeah,
kind
I
of
think
the purpose of the podcast, that we shouldn't just pinpoint a reason to an effect, right? We should consider all variables, and these are actually one of the variables that are a little bit more within the internal of the markets, right?
exactly, and I really like how you put that. That's it's not like we can look at these forces and predict things perfectly. It's just highlighting that, hey, there are these internal dynamic forces, and they can be very powerful, and they can lead to things in the short term that, oh, that doesn't make sense. I thought there was stimulus. I thought the vaccines would do this, and it's like, yeah, those are all forces at play. But by the way, there's these things that you aren't even looking at that can have a huge impact, and we'll see how it all plays out. And I think and this is kind of driving our kind of mantra over the last few months of, hey, make sure you have some cash set aside and you're ready to take advantage of some sort of big dip in the price of gold or gold mining stocks. And so I think that's still there's still a possibility that and a decent chance of that. And how we've talked today about how some of those forces might play out and give us that opportunity in the coming months.
Okay, perfect. Let's sum it up. That was a great chat. Thanks, Steve.
Yeah, thanks a lot, Rafael.